Welcome to Retirement Reimagined, a series of conversations exploring the latest FNB retirement survey and what it reveals about the average South African's preparedness and attitude towards retirement. In each episode, we delve into the survey's findings and examine interesting themes, including how second careers and entrepreneurship are becoming important components of retirement planning. We take a realistic look at the financial requirements for a comfortable retirement and the obstacles preventing us from taking action to meet our retirement goals. I'm Maya Fisher-French, a personal finance journalist, and today Deepesh Desai, CEO of FNB Life, and I will have a very interesting discussion about how insurance can be used in retirement. So Deepesh, one of the stats that I found quite interesting for me coming out of the survey was how much people spend on insurance relative to retirement. It's actually quite a high spend. People tend to spend more on insurance than retirement. And I don't know about you, but every month, my husband complains to me and he says, we're spending all this money on life insurance and disability insurance, and we could be putting this in towards our retirement. So how do we look at insurance as part of a holistic financial plan, given all these other things that we're supposed to be saving and investing towards?
I'm glad you asked this because it's actually not individual things. Financial planning is one entire spectrum of which there are life insurance components, there's retirement components, and there's actually just how much are you spending on your groceries even, and it all really is interrelated. But I think the most important place to start thinking about this is insurance is normally something that you need when you're not there to fund something. And largely that could be death, but it could be you suffer a debilitating illness and now your income can't really support your remediation on that illness, or you can't work and so you need an income. So start thinking about this the minute you have responsibilities or dependents which could be yourself, if you think of a critical illness. And then you need to structure a plan around what would happen in the instance that peril actually occurred. So the converse to that is if something happened to you, for example, you had a critical illness and now you needed to change your lifestyle and change your income, how much would you need so that your life doesn't change drastically? And if you are sufficiently covered for that amount, then you can start thinking about how you're spending. I think sometimes people do neglect the fact that retirement and insurance aren't mutually exclusive. So you may retire, but if you still had a critical illness, you may still need to draw on those savings to now pay for some emergency healthcare that necessarily wouldn't be covered, or other types of medical, like refitting your house, for example, if you had mobility issues. If you didn't have insurance, you'd have to draw out of your savings to do that. And understanding what those risks are is, I think, critical to that insurance planning.
So it's quite interesting for me. What I'm hearing is saying that insurance protects your retirement savings.
Absolutely.
So you're doing all that hard work to retirement savings, and one way to protect that is to have insurance. Because I think planning for retirement is almost optimistic. I'm going to live till I'm 90. It's all going to be great. Insurance is kind of like, well, what if it doesn't work out like that? Then I need plan B. So I suppose that's part of plan B. But I think one of the things that I often get from people is, what insurance do I need when? I'm 25, I'm 40, I'm 60. Like, how does one decide how insurance fits in that sort of life stage?
Yeah, and I think that's a really critical question. And your husband's question could be valid or invalid depending on the life stage that you're in. So if I had to take it to the extreme in retirement, your insurance needs would probably be somewhat limited. But for a lot of people, legacy is also a need. So the fact that if something happens to you, your children or your dependents or whoever would benefit from something that you've already been paying for so many years from. So legacy is a need. But your estate also has liquidity needs, or there's taxes upon those estates and that sort of thing. So even at that stage, there is a need for insurance, because if you die and you bequeath something to your dependents, they would still pay an estate tax and estate duty, and you wouldn't want them selling assets for that. But if we take that to every step before insurance, what's critical to understand is if you die, then you have dependents. And at any point in time, depending on the number of dependents you have, depending on their financial needs, that's when you have to think about increasing cover, getting cover, decreasing cover, that sort of thing. But throughout that entirety of the period, you are your own dependent. So if you were unable to work for some reason, you were, had some sort of health condition, or there was a sudden health condition, you would need some protection against that. And it really has to be adjusted to your lifestyle and your earnings. For example, if you were earning a certain amount and you were insured for only 10% of that, if now, for example, you were in an accident and unable to work, your family is hardly going to be able to live on 10% of that income. So thinking about what risks you're exposed to pre-retirement also enables you to understand this. Fortunately, I think, in South Africa, we have a lot of financial advice that a lot of people can access. In FNB specifically, you can contact your private banker and they can even help you with some of these decisions. But I think it starts with thinking about it, thinking through what life stage you're at. And as sad as this sounds, what would the extreme be? So if that extreme event happens, how much would my family actually need?
And I want to swing back a little bit to my husband's complaint. One of the things, and you mentioned having insurance in retirement, because obviously you're thinking, oh, thank goodness, when I retire, I can cancel all this insurance. But actually, there's quite a few things. You mentioned critical illness. So that's actually something we're probably going to have to increase our expenses on, because you're more likely to have critical illness, obviously, when you're older. But also, there are still many people who are supporting family members even in retirement.
Yes.
I mean, that's a reality.
And I think it's a disproportionate reality for South Africa, where there are multiple generations that are being supported. So many people are part of the sandwich generation, or they're supporting the generation after them and the generation after them. I wouldn't necessarily say that you have to increase the cover, because it also gets more expensive. And to an extent, you could even decrease the cover, or you could change what you are covered for. So there is that. And sadly, morbidly, what you'd also have to understand is that if in retirement you did die, whatever is unused of your retirement fund does go to your dependents. So there is still some income that they would live off. But what I'd urge people to really rather think about is, what is your unique financial circumstances? What are you exposed to? And how would those risks manifest in your life? So in your husband's complaint, for example, let's say post-retirement you did have a critical illness and it affected mobility in some way. Would you have enough saved to refit your entire household for those mobility issues? And the answer is unlikely, right?
Well, you don't want to be tapping into retirement savings where that wasn't part of the plan.
Yes, and you could still go on the holidays that you had planned. So it's really about making sure that the income you had planned upon is not disturbed. And that really goes to the heart of life insurance planning. It goes to how I don't disturb what was intended. And if you can fit your financial needs understanding around this, you'll build your life insurance cover that no matter what happens, your life lives relatively undisturbed, or your financial life is undisturbed.
And how important are post-retirement benefits like premium waivers? Do you not just land up paying more for those?
I think, again, it depends on your financial circumstances. And it's okay to pay more for something if you understand why you're paying more and when. So to a large extent, a premium waiver would just happen where you're paying more in your working years for something that you enjoy in your retirement years. And if you're comfortable doing that, then that's also okay. What's also important to understand is that you can also stop increasing your life insurance post-retirement, so you don't have to contribute necessarily more. The one caveat in South Africa that a lot of people have to understand, and why sometimes they think they're spending more on life insurance than retirement, is if you work for a company where your pension is deducted from your salary, largely you're actually only buying your insurance because you don't understand how much you're contributing towards your pension necessarily. So optically, it looks like you're spending more on life insurance, but actually it's because your pension is deducted before you get your take-home pay. Now, what happens with that, though, is once you retire or leave your workplace, you now don't have the life cover that came as part of that pension plan. So in some cases, you do have to increase it. And I think this is why I always go back to understand that circumstances, go and seek financial advice so that you don't make any knee-jerk reactions.
And maybe I just want to end off with maybe a little bit of a contentious point here. But, one of the problems in South Africa is that some types of insurance are oversold.
Yes.
And here I am thinking funeral cover. I'm sorry, but when I go and look at some people's bank statements, funeral cover. But, it's always sort of easy to sell funeral cover, I think, but it's often not meeting the real need. Do you think we need more education in this space? Do you think that people need to have different types of life insurance for the correct needs?
Yeah. So I think we really need to find a way of democratizing advice across the South African income spectrum and access spectrum, because a lot of this funeral cover is bought via a branch, or whereas a lot of more sophisticated life cover is bought through a financial advisor who tells people how much they should buy. So I don't necessarily think that it's always oversold. Sometimes it's actually overbought because people need more cover. So democratizing advice is a huge element. The second big element is products that cater to this missing middle. And fortunately in FNB, we have products that do cater for that. For example, our Life and Legacy plan. But the third thing is also to ensure that consumers trust insurers. A lot of the time, people are buying multiple insurers because they're scared that one doesn't pay and their dependents would be left with nothing. And so making sure that we pay claims reinforces this consumer trust, and then they won't overbuy insurance.
Such a key point. I pick that up a lot. Very, very important point. But I want to say thank you very much to you for giving us some insights into how insurance works in the retirement space, how we look at these different areas, add to my conversations at home. And thank you to our listeners for joining us today. And remember, if you want to know more about the FNB Retirement Survey, you can find it on the FNB website or click on the link below. And please join us for our next episode, where we're going to look at estate planning and how that works when you, as part of your retirement planning. So please join us for that conversation.